Hey guys, Mike from Mortgage Nerds here in Appleton. I am honored to be sitting here with...
Pam from Mortgage Nerds in Appleton.
I thought you were in Green Bay.
No,
Okay.
I mean, I live there, so.
Okay. Well, I'm happy to have you here today.
Thanks,
Pam.
thanks.
Today we were going to talk about seller concessions.
Yes.
It's a nice little topic to educate you guys on how to maybe structure your offer properly to benefit you financially.
Correct.
Right? So tell us a little bit about seller concessions, Pam.
You basically have your agent build it into the offer.
So how do they work first? So give an example of like a $100,000 house, nice and easy.
So if you need, let's say 3,000, we'll just make even numbers.
Sure.
Then you would actually write the offer for 103. And then there would be verbiage in the offer saying seller agrees to contribute $3,000 towards buyer's closing costs and prepaids. So that way when it hits underwriting, they know, okay, buyer does not have to source that money towards...
Seller's paying for it.
Correct.
Now we're gonna elaborate here because this is where I believe it goes off the rails sometimes between realtor, buyer, and lender when you're not on the same page.
Right.
Right? So $100,000 sales price or purchase price, and then you want to do $3,000 in seller concessions to help cover your closing costs and prepaid items. We'll go through that in a little bit more. But the buyer in our office, sometimes they're like, yeah, no, the seller can pay for that. I want to do $100,000, have the seller pay for the $3,000. Then netting the seller $97,000, right?
Yes.
But then when they go to the realtor, then the realtor's like, well, it's a tough market, blah, blah, blah. And then they go, we should really add that on top to make sure that the seller's netting the $100,000 to be competitive in this market. And then they're like, okay. And then sometimes later, after the offer's accepted, they're like confused on why, right? So let's really, really hone in on that. So
exactly.
Seller concessions can happen both ways. You can offer them $100,000 and then have the seller concessions come off that. Or, in my opinion, based on today's market and that kind of stuff, you would honestly add them on top. It's not the it's not the seller's I don't say issue, or it shouldn't be their challenge if you're not going to utilize your own money for closing costs.
And the key is I think the explanation to the seller saying you will still net the same amount regardless of if the buyer was asking for costs or not, because if they weren't, they would offer 97 versus 100, or 100 versus 103, however it's structured.
Right. So then you add it on top. Okay. What challenge does that represent then?
The house has to appraise at what the offer is written for.
Yep. So seller concessions, you're at 100, you're adding 3, now it needs to appraise at 103.
Correct.
Typically not an issue,
right?
Right? But if it appraises at 102, then you need to come up with a little bit of money. And we talk to a lot of people too. I mean, you guys, rates are in the 2s on a 30-year fixed. This is February 2021. Just in case you're watching this 5 years from now. Rates are in the 2s. It makes sense to not put a lot of money out of your pocket, right? To finance as much as possible, because rates are ridiculous right now. So it's a huge benefit to you guys to structure your loan a certain way. However, it presents a different challenge though on the realtor side, right?
Exactly.
Cool. And then seller concessions, because we know mortgages are complex. They're not flat across the board. There's guidelines for each type of loan. So let's go through, just touch base on that a little bit. All right. Conventional loan. Why don't you break down some of the layers of seller concessions?
Okay, so that conventional loan, it's definitely based on your loan to value / down payment. So if your loan to value is 90% or above, so in other words, if you're putting 10% or less down, the maximum seller concession is 3%.
Yep.
If your loan to value is 75 to 90%, so 25% to 10% down to 25% down, the max seller concession is 6%. If you're below 75% loan to value, you can get 9% from the seller. And then that is for a primary residence or a second home.
Primary owner.
Correct, correct. Yep. And if you're buying an investment property, no matter what your loan to value is, the max seller concession is 2%. So.
Cool. And if you're a realtor out there watching this video, hi, realtor, you need to know this stuff.
Right.
Right? Because one of the challenges is buyers, things change outside of our office. Once we talk about things, we come up with a plan. They go out, they look at homes, and then all of a sudden this happens, that happens, and now they're looking at a duplex and that they're not going to live in.
Yeah.
And we don't even know.
Right.
Right?
Right.
As a realtor, good realtors out there, they are really in tune with their business partner, their lender, hopefully, and cross-referencing all the stuff that they're doing. But if you're doing seller concessions, you need to know the layers that are on there.
Right. And some buyers have a very limited amount of resources. It's not like they're not a good buyer, but they just have a certain amount that they can put into the transaction. So by a seller concession, it really helps them get into that home.
Yep. And not to pick on realtors, but I'm going to pick on realtors a little bit, is that some conceptions of that is that just what you said, they're like, oh, they have to do seller concessions. I would love to change the mindset of that to, oh, they're utilizing their money the best way possible, right?
Right.
And this is a pre-approved buyer that wouldn't be a pre-approved buyer unless, we had seller concessions. So this is a huge benefit to be able to do that. A lot of first-time home buyers, it's not that they don't have all the funds all the time. Sometimes they do, they don't. But it's like you don't want to diminish your, like that's a safety net, right?
Exactly.
You want to keep that $3,000 in your savings just in case something happens. You don't want the cash outlay, right? So love to change that mindset of realtors. And again, I fully understanding the market and the other challenge that it presents itself, but kind of weighing that both out. Okay, what about FHA?
FHA across the board is 6%.
Cool. VA loans?
4%. But the cool thing with VA is it's 4% of allowable costs. We can go into that at a later time.
All in.
But the seller within that 4% can pay off, like if the buyer had a judgment or a loan or something.
A credit card.
Credit card to get them to, debt ratio out or whatever it is, that is allowable.
Yeah, VA is the best loan on the market, you guys.
Yes.
Anybody that's hearing this, I want you to know so many different levels and different things that you can do with a VA loan that nothing else you can do like that. VA loan is amazing. So yeah, on a purchase, you could technically, we've had this, pay off a car.
Right.
So then your debt ratio drops down because you don't have a car loan payment anymore, and it's all built into seller concessions.
Yes.
It's a beautiful, beautiful thing. All right, so we covered conventional, FHA, VA. What about USDA?
That is the same as FHA at 6%.
Okay. So that's all of them, right?
Yeah.
All right. So we have all different variances, and really it comes into like loan size is such a huge factor in this. Like you wouldn't need 6% on a $200,000 house.
Right.
That's $12,000. There's no way you could like spend it all.
No.
Right.
If you are somewhere, you need to call us.
Yeah. And well, actually, we've seen some CDs and LEs from people that it rhymes with Quicken. What? What? Oh, they're horrible. There's certain lenders out there that just charge a crazy amount of costs to get just an average rate. Sometimes paying a lot of costs to get a streaming rate like 1.99 or something crazy like that would be relevant.
Smart, right.
If you're gonna be there a long time. But some of these guys, I'm telling you, shop around. That's what I'm telling you. All right, so seller concessions, that covers it up, right?
It does.
Remember,
mortgages are complex.
Let mortgage nerds
give you the answers that you need.